Ladies and gentlemen, let's welcome Kentucky's 6th District Representative to Congress, Andy Barr.
Well, good morning. You can tell I had my coffee that morning. Ballard, good morning. Hope all of you all are well. It's so nice of you all to invite me to be with you here in beautiful Marco for your convention. I really enjoyed listening to Tom Hoenig. Members of Congress on the Financial Services Committee really lean on Tom and his expertise, and great to hear his comments just oozing of common sense, and I know you appreciated his words of wisdom. I'm going to start today by addressing the division and the polarization and partisanship in Washington, and I'm here to bring good news about that. I'm going to make a bipartisan proclamation here with the Kentucky Bankers Association to start us off, and that is that Kentucky is both a basketball school and a football school. How about that? Well, let me touch on a few things. There's a lot of topics that we're focused on in Washington right now. Tom addressed some of those. I'll touch on inflation first of all and monetary policy, because that is the primary assignment that my colleagues and Ranking Member McHenry has given me on the Financial Services Committee as the top Republican with oversight over the Fed. And then I'll touch on a huge topic that's going to become even more pronounced if there is a change in the composition of Congress and there's a new majority, because we will have more oversight over the climate finance ESG agenda that is a focus of the Biden administration. I'll touch then on the CFPB and our important oversight responsibilities with the CFPB. And then I'll talk about financial inclusion and promoting access in underserved communities, the right way to go about that, and maybe some of the wrong ways about going about that, touch on CRA and credit unions a bit, and then finish with digital assets and a real focus of the committee on innovation in crypto, but also some real challenges and potential threats to the banking sector with the central bank digital currency, and then I'll look forward to our conversation. So first of all, let me just say that in addition to the Financial Services Committee, my colleagues have given me a responsibility to serve on the Foreign Affairs Committee. And in that capacity, with oversight over sanctions and OFAC, I get to travel the world and see economies in other places, both developed countries, authoritarian regimes, and also lesser developed countries. And the one thing I would say about American economic competitiveness is that we have a diverse financial ecosystem, which is fundamentally different than most other, even developed economies. Take Europe, for example. Most other Western democracies and free market economies are characterized by just large banks that are highly regulated, almost like utilities. The dynamism of our free enterprise system, in my judgment, is a product of the diversity of our economic and financial ecosystem. So we have a lot of different types of financial institutions in this country, and that's very good. We have large, globally systemic important banks, we have regional banks, we have small regional banks, we have community banks, we have credit unions, we have non-banks, we have fintechs. I think that gives our system a resiliency and a diversity that contributes to dynamism and new business formation and entrepreneurship. And it sets us apart from the rest of the world. And when we think about the folks in this room, community bankers, community banks provide roughly 60% of all small business loans, more than 80% of agricultural loans, and large banks are 5 times more likely than small banks to require minimum loan amounts for their primary loan products, and 8 times more likely to use standardized small business loan products. So when you're talking about opportunities for access to capital, small businesses, new business formation really need a robust community banking sector. That's what sets the United States apart from the rest of the world. Inflation and monetary policy. Obviously, the scale of the problem is profound. It's historic. We're at a 40-year high in inflation. 8.3% was 9.1%, still a 40-year high. Penn Wharton said that this has resulted in a $6,000 reduction in purchasing power for the average household. And according to the NFIB, a recent survey released in July said 37% of small business owners reported that inflation was their single most pressing problem in operating their business. That says a lot given the labor shortage out there. What is the cause of this inflation? Well, it's a classic supply-demand mismatch. You had excess spending, overspending that created excess demand, and then a policy to constrain supply. On labor, paying people to not work, in an energy a war against domestic energy production. We are now producing 3 million fewer barrels of oil a day in this country than where we were 2 years ago. We've gone from a position of energy dominance to energy desperate. That's why you see higher gas prices, certainly higher diesel prices. And I think this recent reprieve will reset. And if we don't invest more in energy production, we're going to continue to see supply constraints. So fiscal policy errors certainly contributed to this, but don't underestimate the monetary policy errors as well. And Mr. Hoenig was talking about this, but clearly the Fed pursued an unconventional and overly accommodative policy for too long, continuing its QE and its highly aggressive $120 billion bond purchasing program all the way through March of 2022, well after this inflation crisis began. They kept interest rates too low for too long, near zero, well after the recovery began, and without taking into account these fiscal policy errors that I just spoke about. And so what we've witnessed over the last 13 years since the financial crisis is the most unprecedented and unconventional monetary experiment in history, in the history of central banking. And the current inflation crisis is the result. And it has fully discredited modern monetary theory as a legitimate macroeconomic strategy. And simply printing money to fuel trillions of dollars in deficit spending is proving to be the perfect recipe for price instability and the erosion of Americans' purchasing power. So what is the Fed's response? Well, the Fed found itself behind the curve and forced into position where it now is pursuing a highly aggressive rather than gradual tightening posture, quantitative tightening, to try to crush the demand side of the economy. And so I agree with Tom, there's likely no soft landing here. I have spoken with Chairman Powell, with Jim Bullard and Loretta Mester, Cleveland and St. Louis Feds, because they cover our area. And they know that there was a mistake that was made here, and they're signaling more fortitude than I think the financial markets have fully priced in. So I do not expect the pace of monetary normalization to slow down anytime soon. I would not be surprised with another 75 basis points increase this month. I predict that the Fed will get to at least the 4% level on Fed funds by the end of this year. I do not anticipate any deviation from this tightening program, both in terms of rate increases and balance sheet reductions in the near term. Of course, the good news for bankers is that tightening means better yields for banks, lenders, and savers in fixed income. But the bad news outweighs the good news, and that's because aggressive tightening without any supply-side help, with rising business taxes that don't allow for CapEx to repair supply chains, when you're not producing energy, when you're constraining labor supply because of bad policy, that means increased borrowing costs for households and businesses, increased deficits from higher debt service payments, and much greater market volatility attributable to unwinding the Fed's unconventional policies. So the prospect of avoiding recession is low, given 2 consecutive quarters of negative growth, rising credit card debt, lower real wages, inflation-adjusted wages, and a painful sell-off in the equity markets. Climate finance regulation, ESG, and the SEC's disclosure regulation, top of mind, top of the agenda. In the last year and a half, we've witnessed the administration's whole-of-government weaponization of financial regulation to redirect capital and financing away from fossil energy. But it hurts retail investors as well. But let me talk about bank regulation first, because before I get to the SEC, because the Federal Reserve joined what's called this Network for the Greening of the Financial System. That's an international group of central banks looking to add capital requirements to not just assess climate risk, but to potentially increase capital requirements and risk weight capital deployed to the fossil energy sector. I sent a letter to Chairman Powell and then Vice Chairman for Supervision Randy Quarles, urging the Fed to proceed cautiously when deciding whether to incorporate climate change scenarios into supervisory stress tests. And the letter raised concerns about many methodological challenges with inserting ill-defined and subjective climate metrics into its tests, and urged the Fed to not simply import climate supervision criteria from European regulators via this network for the greening of the financial system if those tests would disadvantage U.S. banks or American industry. And certainly with respect to trickle-down regulation that Ballard likes to talk about a lot, community banks need to be exempt from any move in this direction because of the burdens and simply politicizing capital allocation. That's not the job of a bank. A bank shouldn't be a Republican bank or a Democrat bank. A bank needs to be an allocator of capital on a fairly neutral basis based on the creditworthiness and sound underwriting, as opposed to politicizing capital allocations. So this is really not about assessing risk. It's about creating financial risk for energy producers unpopular with the administration. It's about politicizing capital allocation and discriminating against fossil energy. And I believe that these supply constraints that we're seeing, because energy goes into everything, all the way down to the retail level, this politicization of capital allocation is really ground zero in the executive branch's war against American energy. The SEC has published and proposed a securities disclosure rulemaking that would reach into the banking sector, requiring publicly traded banks to disclose all kinds of immaterial information for investors. And again, without getting into a lot of the details, because this is really more about investors, consider the fact that the SEC's primary mission is to protect investors. And what this rulemaking will do will require public companies to disclose all kinds of trivial and immaterial information that, frankly, retail investors don't want. The University of Chicago, in concert with FINRA, did a study about whether or not there truly is a demand for this environmental and social governance. And it found that only 21% of retail investors actually know what the letters ESG stand for. So this is going to confuse investors, and it's going to redirect capital away from energy, and it's going to hurt investors. These ESG funds are higher fee, they're less diversified funds typically, and they're lower performing. There's been many studies to show that in the last 5 years, if you were invested in tech-heavy ESG and underinvested in energy, which is what ESG funds are, and less diversified, and you experience this big tech sell-off where energy prices are up and you're missing the energy in your portfolio, what that means is you're losing more. Your losses are greater than these ESG, than if you were just broadly invested in the market in general. So there's going to be a huge pushback against ESG in the next Congress if Republicans take the majority, and we're going to expose both the problem with politicizing allocation of capital and also what this does to retail investors in a negative way, and the importance of not politicizing bank capital regulation for banks. CFPB. Rohit Chopra, the new director there, is pursuing an even more aggressive regulatory posture than Richard Cordray. He's asserting a quote-unquote dormant authority to issue all kinds of new rules without going through the notice and comment process. This is regulation by press release, it's regulation by enforcement, and so there's no due process. The overdraft fee conversation that you just saw there and the junk fees, I know the FDIC is looking at the representment issue, so it's not just the CFPB. But in March, the Consumer Protection and Financial Institutions Subcommittee held a hearing on overdraft fees, and the bill that we considered beyond what the CFPB is doing on its own would limit options for consumers who use overdraft and limit the number of overdraft fees a bank may charge, among other things. You know, the federal government charges a whole lot of fees as well. I don't know why we don't call those junk fees. It costs $130 to get a new passport. Have you ever been to the post office? Are those junk fees? What about the penalty you pay if you don't pay your taxes on time to the IRS? I mean, fortunately, we were able to stop this crazy proposal from the administration that we need to track all of the inflows and outflows from your IRS bank account and put that huge compliance burden on all of you. That was resurrected in this Inflation Reduction Act, not just the Build Back Better bill. Fortunately, we were able to stop that. But this idea that junk fees, that you all are charging junk fees, how about all the junk fees from the federal government? The truth is, as I said in that clip, a lot of these consumers know exactly what these products are, whether it's late fees or overdraft fees, and they use it for convenience. And, the Reg E was amended by the Fed back in 2010 to give pre-election disclosures. The American people know what these fees are. And as I said before, what a recipe for payday loans if you're going to push people out of these products. There's other troubling things going on at the CFP, updating and exam manuals to redefine what discriminatory practices are, and changing the administrative process so that there's not an independent administrative law judge that would adjudicate matters. Those are big concerns. We're going to be working on UDAP and better defining abusiveness. Kraninger in the last administration tried to put some definition around that abusiveness standard. Of course, that was rescinded in early 2021. We're going to be introducing a bill, and I've co-sponsored the bill to totally repeal the abusiveness standard, but we need bipartisan buy-in on this, and I think there can be some bipartisan interest in providing some statutory definition around what abusiveness actually means so that you, as a financial institution, know in advance how to comply with the law. And as Tom Hoenig said, it's not a situation where Rohit Chopra tells you after the fact that your financial service and product was abusive. That's not the way good government works. That's not the way due process is supposed to work. But sure enough, in January of 2022, Director Chopra issued a request for comment on so-called junk fees, and they've received a whole lot of comments. I asked Chopra about junk fees, asking him if he could give any legal or statutory authority to define junk fees, and he admitted that there is no federal definition of a junk fee, and told me that a fee for a service, it is a fee for a service a customer didn't necessarily want. In other words, it is what he says it is a junk fee. And the bottom line is that there is no due process. We need to put definition around junk fees and abusiveness. 1071, I've talked to many of you about implementation of this Dodd-Frank required rule. It's one of the few areas where the CFPB has actually promulgated a rule as opposed to regulation by enforcement. But the problem with the proposed rule is that it's HMDA on commercial loans, as you know, and it would apply to banks that originate 25 or more small business loans per year. It fails to recognize the customized nature of small business lending, and it would, as proposed, it would impose an enormous and costly data collection requirement on banks that would put commercial loan officers in the unfair, uncomfortable, and highly inappropriate position of guessing the borrower's race or ethnic background based on visual observation or surname when the borrower refuses to disclose it. How offensive. This will force many small banks to completely exit the small business lending market, leaving their small business customers with fewer options and higher cost of credit. Remember, the dynamism and the competitive advantage of our system is community bank small business lending. We should not do this in a way that compromises that advantage. Two final points: how Congress and financial regulators can foster competition, promote financial inclusion, and expand access to banking in rural and underserved areas. And then finally, a quick word on crypto and CBDC. So how do we not do this? How do we not promote financial inclusion and increase access? We don't do it with a joint CRA update that is more burdensome and costly. That's not the solution. It's not FDI restrictions on mergers either, because frankly, if you want more competition to the big Wall Street banks, we need more truists out there. And the FDIC is making that much more difficult, extracting these huge CRA settlements in order to approve these mergers. The IRS reporting requirement on bank inflows and outflows, that's not a solution to financial inclusion. That will deter people who are unbanked from going to a bank. But more de novo charters is a solution. And I have a bill that the KBA has endorsed, the ABA has endorsed, Expanding Access to Banking in Underserved Communities Act, that would address this crisis in low de novo formation. We want to phase in capital requirements to give banks more opportunities. What's another way you don't do this? You don't do it by expanding field of membership for credit unions into so-called banking deserts and then lift the business loan lending cap. If you want to do that, then you shouldn't be a credit union, you should be a bank. And I opposed an amendment that was offered to I offered an amendment to take out a provision in a Fed reform bill earlier this year that would have blown open the credit union business loan limit and allow them to expand into so-called banking deserts in a way that would displace community banks. So we're all for diversity, credit unions, but if you're a credit union, you can't be a bank. You need to act as a credit union so that we, again, have that healthy competition and get more, not less, into these banking deserts. And then, in addition to my de novo charter bill, I am supportive of some tax changes that I think would be better than CRA and help you all level the playing field with your concern about farm credit and credit unions. ECORA is a good idea. That's Expanding Credit Opportunities in Rural America Act. That legislation would create a tax exclusion for interest on loans secured by agricultural land and residential mortgages in rural communities. And I'm also working on legislation for the next Congress to exempt banks from tax on retained earnings from loans and opportunity zones. This will really supercharge opportunity zones and, again, help level the playing field between tax-exempt credit unions and banks, and I think would be better than CRA in terms of attracting capital into distressed communities. Another way to help you all is to help you all find more talent in the cybersecurity workforce. There's a huge shortage of cybersecurity. We're working with EKU and their banking school to help them train more experts in cybersecurity. They have a unique opportunity because they've got a banking school, and then they also have this Office of Criminal Justice Training. Combine those areas of expertise to help you all find the cybersecurity experts that you need. And then fintech partnerships have been disrupted after disapproval of the OCC True Lender Rule. We'll be looking at that as well. So I touched on credit unions. Let me finish with the digital assets and the threat of a CBDC, and then I'll love to take some questions. So I oppose, in looking at this, I oppose the Fed's initiative to create a central bank digital currency. I think there's great risk in terms of disintermediating banks, eroding the deposit base by directly competing with community bank deposits, which are desperately needed to fund local lending. Again, our competitive advantage. I think there's tremendous opportunity in crypto. I think private sector development of and innovation in crypto is part of that innovation in the United States. It's frictionless, it's immediate settlement. It can solve a whole lot of problems, especially when you consider what happened with the Robinhood issue. And it's good for payments. But the regulation has to be right. And we don't need a CBDC, a Fed digital dollar, to compete with banks. And I think that is something that we need to really watch very closely. If you're not watching it, I think you should watch it. What's the solution to promote innovation, to make sure the United States is a leader in digital assets, while at the same time avoiding this problem of a central bank digital currency? Well, I think, number one, you have to recognize that the way to protect the dollar's dominance, the way to compete with China, is not to become more like China. China uses their central bank digital currency as a way to surveil their own people, integrate it with their social credit system. That is not the way to compete with China or protect the dollar's dominance. The way that we propose to do it, and we're working on this right now, is a well-regulated stablecoin regime, meaning a fiat-backed stablecoin where you get all the advantages of a cryptocurrency, frictionless payments, real-time settlement, but you don't have the privacy concerns of a central bank-driven digital currency. And you don't have the concern about eroding the deposit base and politicizing lending. That is, I think, the way we preserve the dollar's dominance, get all of the advantages of crypto without disrupting the banking sector. That I think is where the Republicans on the Financial Services Committee and many Democrats are also going, is prioritizing a legislation to create a regulatory framework for a dollar-backed stablecoin. And then private sector issuers, both banks and non-banks, can enter into that space. So with that, a lot to report from Congress right now. There's a lot going on. I always appreciate the opportunity to give you all this update, and I look forward to your questions. Thanks so much.
I feel like we've been drinking from a fire hose this morning in terms of facts and knowledge. You were talking about a dollar-based stable coin. The stable coin we have now hasn't been all that stable. Total capitalization of the crypto market, I believe, has come from a high of 3 trillion down to 1 trillion. Why do you see the future in a private but dollar-backed stable coin?
Well, of course, one of the disadvantages of cryptocurrencies, true cryptocurrencies like Bitcoin, is that they're really not a currency. They're more of a commodity. They're not a security under the Howey test, but they're really not a currency, at least not yet, because they're not a very good store of value. And so how do we get the advantages of crypto? Frictionless, instantaneous settlement, immediacy, while at the same time creating a framework where it's a better store of value, less volatility, like we've seen over the last 10 months or so in the crypto markets? Well, I think the way is to create a regulatory framework for stablecoins, meaning truly fiat tethered or stablecoins, digital assets tethered to the dollar, and allow competition in that space. Who can provide that service to consumers better? Allow the private sector to do it, but have a regulatory framework to enable that competition and choice for consumers. That, I think, would create a crypto asset with a lot of utility, and it really could be used as a currency, and allow banks to participate in that market.
Wouldn't that require, it would require all these private crypto providers to have risk-based capital, and everything to back all that up. Is that part of the structure you're talking about, or is it just regulatory?
It is part of that structure, but it's very important that we have a level regulatory playing field, so that if there is capital requirements associated with that, a non-bank participating in this is not at a competitive advantage over a bank issuer.
Right. Good.
Let's talk about briefly one of the things that I suspect concerns you somewhat, because you are not viewed as one of the extreme elements of your party, as more of a moderate, reasonable guy. David Lenhart, yesterday in the Times, wrote an article about the threats to democracy. How do we become a more perfect union, if you will, and have people working together as opposed to the diametric poles we seem to have now at the national and local scene in politics?
Well, you know, we've had difficult times in our past. Obviously, we don't want to repeat those difficult, polarized times in the past. But the brilliance of the founding fathers, I think, and the framers of the Constitution was they anticipated conflict. Yeah. They anticipated disagreements, and they created a system of checks and balances. They created a system of separation of powers. They assumed that there were going to be very vociferous debates. Go back to the election of 1800, a very rancorous time of partisanship, even in the early days of our republic. So the one thing we have to recognize is let's all, as partisans and people who have different points of view, we can celebrate our differences, but we need to recognize that this is the best system and work within that system. And that's why we have to protect and defend our democracy.
Do you feel we're at a crisis point or moving toward one?
Well, no, look, there's no doubt that there's a lot of division and polarization in our country right now. That's why it takes leadership, and we do have to restore confidence in our elections. We have to make sure that we have election integrity. We also need to have leadership, people who are not willing to compromise their core principles, because that's the American way. That's the First Amendment. We are entitled to have our own beliefs and our own core values, and that's a wonderful thing. But it's important that we listen to one another and be willing to find where that overlapping interest is. And if you do that, you find that you can have bipartisan solutions more often than you think you can. And this stablecoin issue, for example, I mean, we all want the United States to be innovative and on the cutting edge, and we don't want this innovation to leave our borders. We want to be the leader. And there is bipartisan interest in that.
Was Dr. Hinojosa was saying, we are the reserve currency. We are the stable economic influence of the world.
We are, and it's a national security imperative. I just returned from Asia on a bipartisan trip. It was mainly a counter-China threat trip with Democrats and Republicans. We traveled to South Korea, Mongolia, and Taiwan. And I was commenting to my colleague who's a Democrat from Hawaii as we were leaving Taiwan. China, the threat from China is real, and they will exploit our divisions. We need to come together as a country to compete.
Is the threat from the Chinese digital currency real?
I'm not worried as much about the threat to the dollar's dominance with their experiment with the digital yuan. It is a threat. I don't think it's an immediate threat right now, and that's why I don't think the Fed should rush headlong into a CBDC in ways that would compromise Americans' privacy, disintermediate the banking sector, erode our deposit base. That would be very bad for American access to capital and actually compromise our competitiveness. Again, the way to compete with China is not to become more like China and violate Americans' privacy rights or politicize capital allocation or control with more government intervention in currency. The way to do it is the American way and harness that private sector innovation to retain that dollar dominance in ways that don't compromise our competitiveness.
And that's where you see this dollar-backed stable coin.
That's it. That's it. I think that is the way to go. And again, I think there's bipartisan interest in that. I think the Fed needs to take a deep breath. I think they need to pause on the central bank digital currency, and we need to pass a bipartisan bill that creates this regulatory framework for a dollar-backed stablecoin and see where that goes in terms of protecting the dollar as the world's reserve currency status and pushing American innovation in this space forward.
You were talking about regulatory burdens on banks and financial institutions and anti-competitive, if you will, as compared to credit unions. Where do you see the appropriate role of bank regulation in this country?
Well, you know, banks are well capitalized right now. Post Dodd-Frank, as you know, banks are well capitalized. The big banks that, of course, are the source of greatest scrutiny post financial crisis, they performed well in the greatest stress test you can imagine, a global pandemic. They came through with flying colors. Granted, there was a lot of congressional and Federal Reserve liquidity injected into the system, which helped stabilize the financial sector through that period of stress. But that was the ultimate stress test, and they passed. And when you ask Jay Powell and former Vice Chair of Supervision Randy Quarles, where are we on our capital framework, they said, we're about right. We're just about right. Now we have a new Vice Chair of Supervision, Michael Barr, who has come in and earlier this month has kind of upended that and said, we're going to take a new look at capital. And I'm concerned that we will go back to the pendulum will move back under Mr. Barr's leadership. And we will go to a place where we're gold plating everything. That is bad for U.S. competitiveness. And by the way, sidelining all of that private sector capital and forcing banks to hold excess capital means this inflation crisis is not going away, because all of that capital will not be deployed into the private economy to repair those supply chains, to promote that capital expenditure, that business investment that we need to get the supply side moving again.
One of the things we learned from Dr. Hainig is the capital requirement apparently for the big institutions, although ostensibly the same, is not really the same as for the folks in this audience.
Well, that's right. And that risk weighting issue was a really important point that he made. I think simplicity in capital requirements is probably the way to go on that. Now, I do believe that size can equal systemic risk. And so capital requirements for a large, systemically important bank versus a community bank, I think tailoring Ballard is appropriate there. Tailoring is appropriate when you're talking about de novo formation, to enable more new bank formation to start up to get to a capital requirement, not be forced to come in right away at the highest level of capital required. So yes, tailoring in terms of the size and level of systemic risk you pose, because let's face it, if a community bank fails, that's not a systemic risk. If JP Morgan or Bank of America go down, that could result in a systemic contagion.
Too big to fail.
They're too big to fail. And that's why, by the way, the FDIC needs to rethink its anti-merger posture. Truist is a better competitor to Bank of America than BB&T and SunTrust alone because of all of the digital banking and the technology that is now in banking. So I think the answer to consolidation is more new bank formation and regulatory relief for community institutions.
I've been dominating.
I'm going to interrupt John because if you don't, he'll talk all morning. So I'm going to ask you the question.
I was going to turn it over to what I call the amen corner over here.
Yeah, I'm going to ask you the question of I've always said that PPP, and I told my wife during the pandemic, and she listened only because she couldn't get out of the house to get away from me, but that PPP was not only the best thing that happened to banking, but it was also the worst thing that happened to banking. And the worst part is that it showed Congress that the fastest, most efficient, safest way to get to the American people is through the banking system. And now it seems like all of a sudden we've moved into an administrative state where they've said, okay, well, if we want to institute all of our ESG, our DEI, all these other things that we want done, let's weaponize the banking system to get that done. What chances are there of slowing that down?
Well, I think we have good chances. On the PPP front, I think that was the smartest designed program. There were problems, and I know we talked about them, but in terms of having the foresight to liberate community banks through TDR changes and also troubled debt restructuring relief, and also deputizing the community financial institutions to push out that emergency liquidity immediately was really smart, instead of relying on the clunky Small Business Administration bureaucracy to push out loans. You know how the EIDL loans work versus PPP, totally different scenario. And we would have had millions more bankruptcies in America if we had not done the PPP loan. The other smart thing about PPP was it kept employees connected to their businesses, so that when we came out, those employees were still connected to employers. Can you imagine the labor shortage problems we would have? We already have huge labor shortages, but if we didn't keep those employees connected to those employers during the shutdowns, that would have been a total disaster. So in terms of pushing back on ESG, what are our chances pushing back on this politicization of capital allocation? We will, if we take back the majority, it means oversight, oversight, oversight. It doesn't necessarily mean we can pass legislation. I am pushing a bill, and hopefully we can get some bipartisan support for it that would say to the SEC that we're going to slow down this disclosure regulation, and we would impose an affirmative duty on investment advisors under the 40 Act and ERISA plan sponsors under ERISA, and maybe some of these trustees of state pension funds, that your fiduciary obligation is to maximize returns for the investor, for the retail investor. It is not to put non-pecuniary factors like environmental and social governance ahead of returns. And in terms of the bank regulation, again, we're going to expose the fact that this is not about assessing climate risk. It is about creating financial risk for energy companies. Ground zero in the war against American energy dominance is the weaponization of financial regulation. We need more investment, not less investment in energy.
Well, that's what's amazing, because mining copper, mining lithium for batteries is no less abusive to the environment than mining fossil fuels.
Well, that's right. That's
I
right.
just don't
And my view is, look, we all care about climate. We absolutely do. But the question is, in my opinion, what is the better way? What is the American way to address climate change? Is it to add 1,000 pages to the Federal Register and hope that that's going to change the weather? I don't think so. I don't think central planning has ever been the American way. I don't think going to $6 a gallon gasoline is the American way. I think the way to address climate change is through free enterprise, to deploy more, not less capital, more financing into the scientists and the technology and the innovation that's happening in the American energy sector. The best scientists in the world on the issue of climate and emissions and sequestration of carbon and harnessing the carbon cycle, they are in American energy companies. They need more financing, more investment, not less.
You spoke out recently against eliminating overdraft fees. Thank you very much, with passion. I'll give you that. But is it falling on deaf ears? Where do you see your constituents falling in line with that or not?
Well, so there's different fronts on this. There is, of course, the push by the Congress. That goes away if there's a change in the majority. So that stops. But there's still Roy Chopra, and there's still the FDIC. And for the community banks here that are technically not supervised by CFPB because you're below 10 billion, the FDIC will follow the CFPB's lead on this.
Already has.
Already has, on the representment issue, for example. But at the end of the day, we're going to have to really do that searching oversight and make the case and make the argument. And a good point was made earlier. Because the CFPB is so unaccountable, they're not subject to the power of the purse. It's a single partisan director. How do we really, even when we conduct oversight, how do we slow them down? I think litigation has proven to be the check on the CFPB. We can provide the blueprint in the Congress with the oversight about why there are problems with the approach. This West Virginia decision is going to give litigants a stronger hand in reversing some of these very arbitrary administrative actions that don't comply with the Administrative Procedures Act, that don't go through notice and comment rulemaking, and where the agency doesn't have the authority because Congress has not given the agency the authority. The real upside of the West Virginia decision is that it limits that Chevron deference to administrative agencies. And it says only on major economic questions, and I would argue that this fee issue is a major economic question. If Congress did not specifically give CFPB the direction to do what they're doing, then the CFPB, by definition, doesn't have the authority to do what it is doing. And I think we can expose that, and then litigation can actually get it done.
Let me inject an administrative point here. Our clock is winding down, but we might have some extra time, and we're so enjoying hearing from you. I know you have a plane to catch. What time do you need to actually leave?
I've got a little bit more time. I think it's
He's flying Air Deep
1:20.
Well, I'll look to Mr.
No, I'm not allowed to do that.
Well, one of the things you were talking about, PPP, I think, and you mentioned innovation, one of the things PPP did for the banking industry was we needed to get a lot of money out quickly and a lot of different transactions, but it was at the peak of the pandemic and we didn't want to meet with our customers. Well, voila, e-notes. Banks that had never done an e-note in the history of the bank, suddenly every PPP loan they did was under UEDA and e-sign. So I think that helped us along a little bit.
I think so. I mean, that is the future, obviously, and it's a cost driver too for you all. I know that working with core processors and dealing with, upgrading as a community bank trying to compete with regionals and larger banks that have bigger scale and more investments in technology, that's a real challenge for smaller banks. And so we've got to figure out ways to make sure that you can get there in the 21st century. But also, we need to preserve the community bank precisely because in rural and underserved markets, there's a lot of folks who still don't have broadband. There's a lot of folks who are accustomed to going to that bricks and mortar corner branch in downtown USA, Main Street. And when you talk about de novo formation and the decline of bank branches in rural markets, that is a problem if there is a digital divide and you don't have maybe older customers or rural customers who really have access to that digital banking.
You hit on it about core processors really play a huge role in what community banks can and can't do as to how fast they're going to adapt their software to what the community bank is demanding. And that has always been a problem. How do we go about addressing that? Is there a way to, I mean, one's a private industry, well, they're both private industries now that I think about it, but one happens to be regulated by the government and the other one's not.
Yeah, I mean, look, innovation and competition and choice is the best thing. The more, the better. The more competition, the better. We need to foster more competition that will lower cost. I think this was a really negative decision, the Congress invalidating the true lender rule. We're going to have to come up with a way to make it low cost for community banks, smaller banks to partner with fintechs in a way where your customers have access to the technology. Now, you can do it on your own if you are willing and able to invest and do it on your own. But if you don't have that, how are you going to compete with the regionals? How are you going to compete with the big banks? Fintech partnerships is a way forward so that you can serve your customers in that digital space.
So, and I'm not trying to get you into political trouble here, but to fall back on what Jay was talking about on the NSFs, I look at it as a retailer problem, not a banking problem. This multiple presentment of checks, if somebody submits a check, we turn it back, retailer turns around and sends it right back again. And a lot of our banks don't have the technology to be able to pick that up. So
Right.
it's a representment, and all of a sudden, it's our fault. It's not the retailer.
Even
What's the
more
chance of getting
so
the retailers involved in this chain?
Even more so with ACH multiple presentments.
Yeah, it's a good point, and it's a legitimate concern. You kind of created a segue to another issue that we're watching, and I probably presented too much information, but here's another one, is that there is a bill, and it's bipartisan in the Senate, to resurrect Durbin and expand the Durbin Amendment to credit and also add more routing requirements that I think could be a big problem if we don't educate members about what this actually would mean in terms of, for their credit cards. It would mean less rewards programs, for example, higher costs, less innovation, and we're all for competition, but we don't want a situation where merchants are pocketing the savings of a cap, and then financial institutions are stuck with the cost of that.
One of the greatest things I've heard this morning is you use the term bipartisan multiple times.
Yeah, there's more bipartisan conversations, opportunities than I think the American people see. Now, we have huge disagreements on large issues like what's caused this inflation crisis.
The ones that make the news.
The ones that make the news, obviously there's a pretty big philosophical difference about immigration and the border. But on issues where, innovation in crypto, sometimes, on this, for example, on the Durbin Amendment, there may be more bipartisan consensus on the Financial Services Committee about why we should not expand Durbin. Can't say that for sure, but there is bipartisan concern about that. And maybe the real fight is between the Financial Services Committee and the Energy and Commerce Committee, which is closer to the merchant community. And I love to always say that as a Republican, that my adversaries are the Democrats, but my enemy is the Senate. Because there's a lot of good ideas that die in the Senate, and my Democrat colleagues say that sometimes too.
I'm good. I love the guy. So, I mean, what am I going to ask him?
Well, I've known him longer than anybody because, as I've told you, his father lived across the street from me. So,
Well, can I just say thank you for what you all do. You're underappreciated by too many. Although I'll say, 9 out of 10 respondents to surveys say that they're happy and satisfied with their banks, but you're demonized a lot by regulators and others, maybe in the media too. But again, you're very, very important to the financial and economic dynamism of our country, that perspective of looking at the international financial landscape and seeing what's unique about community banks is, I think, an important point that we need, and a story that we need to share. Our office is always open, whether your bank is serving my constituents in central and eastern Kentucky, or you're outside in the state. We want your feedback. I can't tell that story about the woman whose husband was deployed and she needed that overdraft protection. I could not tell that story if I didn't have a relationship with you, because you're telling me those stories. I'm your voice, so I can share that, but only if you give me that feedback. So this is an invitation. Share those stories so that we can counter these narratives that all you're doing is junk fees. Actually, this is a service that people want. It's a service that people need. It's in demand, and it actually is lower cost than the alternatives out there. So our relationship and your feedback to us is really important to allow me to represent you and your customers in the way that hopefully we do. So thank you very much.
Congressman, I can't thank you enough for all the battles you take on our behalf. And you've been consistent. You've never backed up. You've had several opportunities to, and you've never backed up. And I talk with my counterparts around the country. You and I were talking about this the other day. I get more calls about Congressman Barr from people in Utah and Maine and Texas than I do in Kentucky. And they absolutely love you. We love you. And I can't thank you enough for being our warrior out there.
It's an honor to be with you, Ballard, as always. Thank you, Jay. Thank you. Appreciate it. Thanks, John.
thank you. I appreciate you doing what you do.
Thank you.
I hope I'm going to send somebody to join you.
I know. I think you are. Thank you. I appreciate it.